Hello everyone, and welcome to today's webinar, Management by Metrics, Best Practices for High-Growth SaaS Companies. My name is Rihanna Collier. I'm Vice President of the Software Division at SIIA, and I am delighted to be joined today by our presenters, Lauren Kelley, who is the Chief Executive Officer at OPEXEngine, and Tyler Sloat, who is the Chief Financial Officer at Zuora. So for several years, the SIA has been delighted to partner with OPEXEngine on an annual software and SaaS benchmarking report that they produce. Benchmarking is an extremely useful tool to identify critical metrics that successful companies use to evaluate their businesses. And so during today's webinar, Lauren will talk a little bit about the importance of benchmarking, what metrics you should pay attention to, and how to use benchmarking to grow your company. And then Tyler will also add his views on benchmarking and what metrics he finds to be critical to optimizing business growth. Before I turn it over to them, just a couple of key housekeeping reminders. All of your phone lines are set on mute. We do want to make sure that we answer all of your questions, so please ask your questions via the chat box there on the left of your screen. Both Lauren and Tyler will go through their presentations, and then we will have time at the end to answer as many questions as we can. If for some reason we don't get to your question, we will take your question offline, and I will make sure that we get a response back to you in a timely manner. This webinar is being recorded, so all participants will receive a copy of the recording itself along with the presentation. I know that's a question that comes up a lot, so you will receive that very shortly following the webinar. Now quickly, I just want to highlight a couple of key SIA events that are coming up. First is our Deciphering Finance event taking place April 30th at the UC Irvine campus in Southern California. This is a one-day event for CEOs and finance executives to come together to really discuss growth strategies for software companies. The website's there on your screen. Again, you'll have the presentation, so you'll have the web address as well as my email address is there too if you have any information or any questions or need additional information. You can contact me directly. Hopefully if you're around that area or can manage to be in that area, you'll join us. We did a similar event to this in Boston back in December, and the feedback was extremely valuable, and so we're hoping to recreate something similar on the West Coast. Next, I want to highlight the SIA's annual flagship event, Maximize, which is our industry ISV conference taking place May 20th through 22nd in San Francisco. Our theme this year is all about growth. It's all about maximizing opportunities for ISVs to grow quickly and efficiently. So if you're interested in attending or participating as potentially a speaker or a sponsor or a partner of the event, again, please let me know. The website's there on your screen, and again, my email address is there for your information as well. So with that, I don't want to take any more time. I want to turn it over to why we're here today. And we're going to start with Lauren. And again, Lauren is the CEO of OPEXEngine. So Lauren, I want to turn it over to you.
Thanks very much, Rihanna, and welcome everybody. Good morning and good afternoon if you're on the East Coast, which is where OPEXEngine is based. OPEXEngine, just to give you a quick overview, I started OPEXEngine 8 years ago after about 25 years in the tech industry, some big companies and some smaller companies. And I started OPEXEngine because as an executive and also as an officer of a public company, I always felt like it was frustrating when making critical decisions, even small decisions about adding headcount or bigger decisions about the final company budget, that we didn't have very good comparables to look at and didn't have good operational metrics that we could compare. We had our own internal data, but we never had it for third parties. And you spend a lot of time trying to pull that data together and getting it anecdotally, and so that's what OPEXEngine is dedicated to. So we've been, as I said, we've been doing this for 8 years. We run an annual benchmarking survey specifically for the software and SaaS industry, covering companies with revenues of 1 million up to this year it'll be about 500 million. So it's about half public companies, half private companies. We have a lot of the companies that have recently IPO'd, a lot of companies that look like they may IPO in the next year or two, a lot of venture-backed firms. But what I think is also great, and we saw particularly strong last year's benchmarking, a lot of companies that have sprung from the United States outside of the two coasts, or in between the two coasts, I should say, that have built really strong businesses. They're not maybe as well financed or growing as fast as some of the venture-backed firms, but really strong businesses, and lots of them are public. So what I'm going to talk about today is a little bit how we see companies using the benchmarking and how to approach it, and then some of the data that we're seeing. One of the key things that I find, first and foremost, is for companies to really get a sense of how they want to compare themselves to other companies. It used to be if you were going into SaaS, everybody wanted to compare themselves to Salesforce.com. Well, there's a couple of reasons. I mean, it's obviously interesting to watch them, and they're a terrific company, and lots of us use them, obviously. But we're talking about a company that's been on the market for quite a long time in this fast-paced world we're living in right now. And it's, a more than $1 billion company. And if you are a startup company, a private company, your metrics are not going to look anything like Salesforce.com's. And the other thing that I think companies oftentimes do is they want to see comparables for competitors, for companies that are selling in the same exact space as they are. And I think that really doesn't work very well, because typically in every market you're going to have some very big competitors, and you're going to have some mid-sized companies, and you're going to have some startups. And if you're going to aggregate and average out the financial data for each of those companies, you're not going to get a very good guideline or benchmark for where you might want to be. So companies, we break the data out in lots of different ways, both by revenues, but also by business model. And we dig into it a little more deeply, and we look at it by whether it's venture-backed or not, because that can drive certainly expenditures in certain areas and growth rates. We look at whether you're selling large average contracts or small average contracts, and at the same time, if you're selling large contracts, you typically have a smaller number of customers, and if you're selling, a low-price product, you have a high volume, probably inbound marketing model, which would mean your spending is in different areas. So looking at that, then companies take the benchmarks and use them actively within the company on a regular basis. The companies that have been benchmarking with us for a couple of years or more, and use it as a constant sort of way to check how they're doing. Most companies today have great tools out there and great systems, for example, like Zuora, and some other products out there to make sure that you are on top of your internal metrics. And the issue is really making sure that you're then comparing those actively with your peers and seeing how the models are changing. And because what we do see in the benchmarking, having done it for the past 8 years, is that companies are finding efficiencies in all sorts of areas, and that the data does change, sometimes very slightly, but sometimes more dramatically year to year. So it's important to stay on top of that. So what I thought I would do now is talk a little bit about how some of the metrics, how the business model, I think as we all know, business models are continuing to change, but moving from a traditional software company to a software as a service company, it makes your operations function differently, and therefore different metrics are important. Traditional software companies had less visibility, lived quarter to quarter typically, whereas software as a service is a numbers-driven model. Once you have some critical mass and you have some revenue and you have some sense of what your typical churn is, renewal rates, and you have some sense of what your cost of doing business is, then you can, and you also have some sense of what your new customer adds or new subscription adds are, then you can run a model that will give you a very, pretty accurate picture of where you're going to be month to month or even for the rest of the year. And that puts the power of putting that model together into the hands of finance, whereas in the old days, back when I used to run sales organizations, sales was the one who was the closest to what the numbers would be in terms of revenue. But that means there's a lot of moving parts and a few more metrics that you need to stay on top of, and largely a lot of that comes from understanding the customer base and understanding the probabilities around keeping customers and adding new customers. So there's all these new metrics come up that really weren't being tracked by companies 10 years ago, or for lots of companies even 5 or 6 years ago. And they fall into a couple of areas. First, revenue. We're talking about recurring revenues. And I'll talk about that a little bit, and Tyler will talk about it, being intimately involved with that every day at Zuora. And then there's a whole host of customer metrics that companies are tracking in order to give them better visibility, both to, again, the financial model and what the company is going to produce, but also being able to highlight areas that are not as efficient or where you could find more efficiency. And then the other area that companies are tracking, obviously, is cost of revenue and expenses. And hosting expense, as you probably know, primarily falls into the cost of goods for software as a service company. And there's some interesting trends in that area, as well as there's more providers out there, there's more technologies out there. So we'll take a look at that in addition. One point I would make, and I'm using really just as sort of an example of, now that we're talking about all these non-GAAP numbers, how they are defined makes a big difference in terms of how you look at it within your own company and making sure that everyone in the company sort of understands the definition. But then also when you're comparing it to other companies and, taking, for example, there's lots of discussion between whether you should track monthly recurring revenue as it is, or just the contracted or committed monthly recurring revenue, meaning one-time only sort of service projects, or any kind of limited recurring revenue would not be included in that number. And there's some purists who would say that CMRR is a better number because that's a better predictor of the revenue going forward that you can depend on. But to some extent, it depends on your business model. If your business model regularly, each customer, there's some additional recurring revenue that's not long-term but just short-term, then that's something you can depend on. But none of these are really GAAP or industry-defined terms. So when boards or other folks are talking about certain numbers, it's very important to make sure that everybody's on the same page. And, we like to, certainly in our benchmarking, we're very careful and work with each and every company in terms of every single metric that's put into the benchmark in terms of how they're defining it. So what I thought I would do here, just taking at the top level, churn or renewal rates. Just pointing out, again, from a definitional perspective, there's sort of two ways of looking at it. You can look at the number of customers that have renewed or that you've retained, and we actually have switched the term for this year from customer renewal to customer retention, so that you're looking at the net customer retention rate. And then dollar renewal rate is referring to the total net value of the contracts that you made over the year. So if you had, let's say, just to explain the difference, if in 2013 you had 100 customers and you renewed, all 100 of them were up for renewal in 2014, and in 2014 you kept 90 of them. That's a 90% customer renewal rate. But if you reduce some contracts and increase some other contracts, and you started out with $10 million worth of contracts and ended up with 9.5, that would be a 95% dollar renewal rate. And what we typically see in general are just a couple of general trends. Companies typically have higher dollar renewal rates than customer renewal rates, which makes sense. And we also tend to see the companies selling enterprise software, so bigger contracts to bigger companies, typically have higher renewal rates. And companies that are selling a low-price product to a high volume of particularly smaller companies have lower renewal rates, oftentimes in the 80 or 85%, as compared to an enterprise software renewal rate, which typically would be in the 93, 95, or even better rate. And what I'm showing here is just three slices. Within private SaaS, for example, we would see big differences when we break it out by both the size of the company, but also by the size of the contracts. And same thing with public SaaS companies. Hybrid companies, interestingly enough, do tend to have pretty high renewal rates, I think because as they transition from perpetual license to SaaS companies, they tend to stay very close to their customers, or at least that's what we've been seeing with the ones we've been working with. So in looking at just some other areas that we like to look at in terms of the metrics and key areas that are of importance to SaaS companies is looking at growth rates. And we'll talk about that a little bit more with some of the public companies. But generally, we see an interesting trend that growth rates used to be thought of as always sort of going down slightly as companies get bigger and bigger, because the revenue that you're using as a denominator is getting bigger and bigger. But what we tend to see with companies today is that a lot of the, certainly the venture-backed firms in the $18, $20 million range or so, $25 million, are taking quite a bit more money and really ramping up the revenues and ramping up growth rates. And so we see a very big uptick in general. And these are median numbers, so we have plenty of companies that are at 100% growth rates or 200% even. And median, you can see some of the averages in terms of the venture money going into these companies. So just looking at also IPO, growth rates at IPO, here's a few companies that have gone public fairly recently, but certainly most of the companies that we've seen going public in the couple of years have been at least in the close to the 50% revenue growth rate. And what's interesting is I took here in this slide, and I'm sorry it's so small, but when you get a copy of the presentation you'll be able to see. This is about 30 public SaaS companies that is looking at their 2013 numbers, and these are all companies under 300 million. So in that range, roughly between 90 and 300 million or so. And if you see the green line is the revenue to market cap multiplier. And that's just an easy way of seeing how the market is valuing these companies' revenue. And then the purple line is the most recent annual revenue growth. And it's pretty amazing how closely it is aligned, although there are a few outliers, as there always will be. Demandware, particularly, has one of the highest revenue to market cap multiplier, yet they only have about 30% growth. So obviously other factors can come into it, but clearly those two data points are pretty closely aligned. And then moving from, so we talked about customer metrics a little bit and certainly renewal, and then we talked a bit about revenue growth. And now looking at gross margin and some of those areas. What's interesting, and in a way this doesn't totally reflect it, but we are seeing SaaS companies become somewhat more efficient, and it'll be interesting to see as the market or the technology and business model becomes slightly more mature. Right now, SaaS companies on average in 2012, we don't have enough of their returns from the 2013 companies to make a good comparison, but it'll be interesting to see. It's not too different from the software industry as a whole. But we are seeing, for example, companies, and I think part of that is because you have the pressure of the companies that are going after the highest growth are investing the most in their, or also maybe building a lot more redundancy into their hosting and their performance and their security than you typically see, and certainly perpetual license companies, with a stable, more stable cost of products can bring down that cost. So it's kind of interesting to see how much of a difference there is with the high growth companies. And one area, obviously, for the SaaS companies that affects that, and again, I apologize, this is a little hard to see. The blue line down across the bottom reflects the total cost of hosting as a percentage of recognized revenue. And it's roughly in the 5 to 6% of revenue, although there's a little bit of a bump up here for the earliest stage companies, and then it goes down, and then it sort of increases a little bit. But what's also interesting is to look at within total cost of hosting, how much of that is spent on third-party hosting and how much of it is spent on in-house hosting expenses. And we do see as companies get bigger, their portion that they're spending in-house versus with third parties does increase. Although it will be really interesting to see for the newest companies, the companies that are currently under $10 or $20 million in revenue, whether they also follow this pattern or whether they will continue to optimize using third-party hosting companies. And that's something that will be really interesting to watch over the next couple of years. So just to wrap up here and move on to Tyler's presentation, I just want to mention a couple of the areas that we see just from the numbers in terms of what companies are spending, that there's a couple of operational issues that are really coming to the fore going into 2014, and we're currently seeing them. And that is really issues around security. And so from a financial perspective, what does that mean when you're building a SaaS company, and what kind of investments do you need for security, performance, and redundancy? We're also seeing from the numbers that companies are expanding into Europe, even though the European market, certainly is still lagging a little bit behind the U.S. I say a little bit market in terms of economic performance. SaaS is definitely starting to pick up there, and especially if you can answer some of these questions around security and performance and for international and particularly European customers. And we're also seeing, early on when SaaS first started up, everybody, most of the SaaS companies I talked to said, we sell direct. There's no room in the model for the channel. And for example, in last year's benchmarking, very stark difference between venture-backed, fast growth private companies had clear numbers around their channel versus older companies and also companies that were not venture-backed. So I think definitely it's something in terms of selling indirectly. And this is sort of rise of virtual operations, talking about it used to be talk about outsourcing IT and cost savings around having IT organizations either on contract or salaried in parts of the world that were less expensive. But that's really been driven much beyond R&D, I think, as everybody knows. Marketing, everything from a lot of finance functions to marketing and even sales, even for smaller companies, not just the big companies that have telemarketers in the Philippines or in India, but even smaller companies are taking advantage of that. And that, obviously, coming back to what we focus on, has impacts on the numbers and impacts on the efficiency of different ratios. So with that, I'll conclude and make my parting slide. I like to point out that sports athletes and teams are constantly looking at other their competitors' performance and learning from that and incorporating into their own behavior, and by that driving performance. And we see the best companies every day doing that and driving us to give them better information about what's going on in the market. So if you're not doing that, I encourage you to take action and get information as quickly as you can in that area, and whether you work with us or with someone else. But we'd love to get started with you. And the software benchmarking for 2014 is only open right now from March through the end of April. So if anyone would like to follow up with me afterwards, I'd be happy to talk to them. But with that, I'll turn it back over to Rihanna and to Tyler. Thank you very much.
Thank you, Lauren. I want to remind everybody we're going to address all of the questions at the end of the next presentation, but if you do have questions, please go ahead and ask them at any time via the chat box to the left of your screen. And as I said, we'll get to those as soon as our next presentation is over. With that, I want to turn it over to our next presenter, Tyler Sloat, who is the CFO at Zuora. Tyler?
Thanks, Rihanna. I really appreciate it. Lauren, that was great. There's a ton of really good material in there. For those of you who don't know, Zuora is the global leader in subscription commerce, billing, and finance solutions. The company was founded 6 years ago, really with the premise on the foundation of two things. One, everything is going to be moving to subscription. It is a philosophy that started the company, but we now see it coming true. And two, that the current systems out there aren't really enabled to allow for success in the subscription economy today. We're really proud of the fact that our solutions have been helping our 500 customers across technology, media, entertainment, telco, wireless, and consumer service verticals either accelerate their growth in the subscription economy, that whether that's through allowing them to price and package in a more flexible manner, or just allow them to take on the scale that they've achieved through their success, or allowing companies who are not in the subscription economy to really enter and to utilize new systems that aren't currently available to them while they make this big shift. Just some background. This shift that I just referred to, we see it all over the place. We see it in every single vertical. In fact, we have companies in verticals present themselves to us all the time that quite frankly shock me. in terms of that, I would have never thought that a traditional product economy in some of those verticals would be shifting. But everybody's really thinking about, how do I move from selling a product to having a relationship with a customer? And in having that relationship, being able to have a monetary relationship that's quantifiable, that allows for a business model that allows for ongoing success. We see that 4 out of 5 companies, this is just from The Economist, some background, are shifting to new models of consumption. And over 50% of companies, and this again is from The Economist, are going to be changing the way that they price and deliver goods and services. We see this shift not just in broad terms, but we see it very finitely to subscription. And that is the way that people are talking about it. We see it happening, maybe because the companies know that it's a better business model and that Wall Street's going to reward them. But fundamentally, we think that happening because companies realize that if they shift to subscription, it puts more of an onus on them to form a relationship with their customer, whether it's a B2C company and that customer is really an individual, or it's a B2B company and that end customer is a business that they need to focus on delivering a product and good that is going to be received and fairly valued, so that customer will continue to stay with them. Fundamentally, when this shift happens, we see 3 segments that create differences between the product economy legacy businesses and subscription economy legacy business. The first segment is commerce. We think it's different in the way that customers onboard their end users, and that difference is going to be either through web if you're a B2C business, or probably through a direct sales channel with your B2B business. We see a difference in the way that customers execute their financial transactions with their customers, their end user customers, and that really can be boiled down to a billing and invoicing relationship. But when you set up these businesses correctly, the amount of transactions that can occur in that world and the amount of pricing and packaging flexibility that you need to be successful really cannot be accomplished through the traditional ERP systems. So those relationships are different. And then there's a difference in finance. Lauren's talked about a lot of non-GAAP measures. That is the purpose of our webinar today, right? To dig into finance and what are the metrics that drive subscription economy businesses, and why are those metrics different than traditional product economy businesses? And that's what I want to spend my time on today. Fundamentally, GAAP is broken for subscription economy businesses, meaning that the purpose of GAAP is to have one common language in which companies can be put under a lens, and that investors can evaluate them. And then there are requirements around disclosure around GAAP financials so that all investors have an equal footing. But the reality is for subscription-based businesses, there are a ton of non-GAAP measures and a whole bunch of different ways that these companies are being run that aren't reflected in GAAP financials. And so when that happens, the investment community is forced to try to translate GAAP into subscription. At Zuora, we understand this, and it's not always perfect in terms of the lens that we have because there's alternatives in terms of measurements. I'm going to go through today the way we think about the business. But we do live it as well, meaning that our operating plan, the way we run the company internally, is really around subscription-based metrics. And then we think about how to put those metrics together and actually come up with what we will call a subscription P&L in order to reflect the health of the business. I have in front of you right now 2 different fundamental differences between a product economy business and a subscription economy business in terms of an income statement. On the left, you'll see a traditional GAAP presentation of revenue, COGS, gross profit, and the OPEX associated with that, resulting in a net income. On the right, you see what a subscription economy income statement would look like, starting with ARR, annual recurring revenue, and thinking about the churn, or that revenue that leaves every year, and then the cost that you have to pay to maintain that revenue, and then the cost that you have to pay to grow that revenue. The fundamental difference between those 2 statements is that a product economy business looks in the past and tells you what you did, and then expects you to do it again. The subscription economy income statement recognizes the fact that you've built a book of business, that you've invested in your growth over time, and that investment has rewarded a company with a recurring revenue model. And the goal is to keep that recurring revenue and grow it, right? Again, keep it, meaning reduce churn, and grow it through new ACV and annual contract value. Fundamentally, we believe it starts with ARR. Now, Lauren had MRR up there, and we have customers who manage their business by QRR, quarterly recurring revenue. ARR works for us. It doesn't mean that it shouldn't be something else for another company. I think it has a lot to do with the type of business that you are. MRR, I think, would be much more applicable to high volume, more B2C looking businesses that have high volume sales, might have high volume churn, but they also have very short sales cycles, so they can measure investments in conjunction with acquisition. But if we just boil it down and simplify it, for the purpose of this webinar, and normalize everything against annual terms. The highest level equation that you should be running your business on is ARR and the growth of ARR, and that's really entering ARR minus churn plus new ACV, which is annual contract value, equals exiting ARR. And you can measure that for any period. You can measure it monthly, you can measure it quarterly, you can measure it annually, right? But that ARR number at any point in time, you can point at it and that this is my ARR. It's almost like a balance sheet item from that perspective. You would then take your ARR and kind of overlay it against a couple of what we would consider key metrics. And in fact, we talk about these 3 metrics that matter. And the metrics are underlying maybe a little bit deeper than the investments that you would make, but they are the metrics by which you're going to run the health of the business. And we consider those the most important metrics to be these 3: retention rate, which is the inverse of churn, recurring profit margin, which I'll explain in a second, and growth efficiency. So churn, everybody gets the name of churn, but the reality is companies all disclose churn in a different way. You have gross churn, you have net churn, you have churn that somebody could say is gross churn, but they're including upsell in it. You could say it's churn where you're really looking at the ARR growth of the company, or you could say it's just raw dollar churn, right? It's dollars exiting that were representative in an ARR balance at a point in time against which you're measuring it. The key thing for your company is, number 1, be honest with yourselves. So you should take probably one of the most negative views on churn. 2, never double count. So if you're going to include upsells in bookings, then do not include it in your churn calculation. And 3, be consistent, right? Whatever measurement you have, you need to make that the continual measurement, because that'll be your benchmark. Whether it comes off as a negative churn number, which a lot of companies report, or just a true gross churn that is a positive churn number, which to me it's negative. Whatever it is, you need to be consistent so that your business can run themselves accordingly. Now, recurring profit margin is what we consider the drumbeat expense that you need to pay to maintain your existing install base. And that for us at Zuora, that's COGS, G&A, and R&D. And those are the costs that you pay to service that base and to minimize churn in this case. All right? And theoretically, at any point in time, if you saw your market go away and if you had minimized your churn to 0, again, theoretically, you should be able to look at you should be able to essentially bring your sales and marketing expense to 0, spend your recurring profit margin, and if you understand that dollar, you should be able to bring a profit to the bottom line based on your ARR base. And 3 is growth efficiency, which is really the measurement of your acquisition costs. Now, some people use magic number that Lauren referred to. Some people use the CAC ratio. We've really simplified it here, which is our growth efficiency, which is our sales, marketing, and customer success costs over our new ACV. And again, consistency is the important thing here because it will normalize over time. Now, I just mentioned this doesn't necessarily give you the indicator of how much you should spend, but it is the metrics by which you measure that spend. The first thing we do as a company is actually determine how much we should spend. And we base that off of ARR. And so we have goals that we want to spend a certain percentage of entering ARR on growth and a certain percentage of entering ARR on non-growth. Now, non-growth, for us again, just as a repeat, is would determine our recurring profit margin, which is COGS, G&A, and R&D spend. The growth is the sales, marketing, and customer success. Effectively, at the very basic level, if you're going to spend more than 100% of your engineering ARR, you are signing up to burn money, right? The nuance there is, one, what your churn is, because that will decrement your ARR, and that some of your growth dollars would just be used to replace that. And two, how much of a hockey stick and collections do you have in your new ACV? If you're collecting it all up front annually, then you actually and you have zero churn, you're not going to burn, the $25 million that I have on this slide, because you actually will get paid back some for the growth that you actually make. Most big enterprise companies that are B2B, they have hockey sticks, whether it's in month or in quarter, and oftentimes those payments specific to the last quarter will get pushed out, right? And you're spending more in that last quarter if you're growing, and so that new ACV you're making in that last quarter is higher than the ACV you had in the first quarter, and so you will burn capital. But what is very important here is to understand these two elements of spend to be able to give you a flavor of how you're going to plan for it. So at Zuora, to give you an example, we say, okay, we're going to spend X amount in growth and X amount in non-growth, and we measure it off of entering ARR into any quarter. And so it's a conservative view because we have ARR entering a quarter, and then we say, okay, we're going to spend, say it's 50% on non-growth, we're only going to spend 50% on COGS, G&A, and R&D in that quarter. As ARR grows, those functions get to higher. But if we keep it to that level, we know that we will never get too far in front of our skis in relation to those true recurring costs. From a growth perspective, we are growing very, very fast, so we're accelerating. It makes sense for us to invest there. But we say we're going to spend, theoretically, based on the slide, 75% in non-growth, but then we'll hold ourselves accountable to the third metric there, which is growth efficiency, which gives us the efficiency of that spend and lets us know whether we're getting the payback that we want. If we continue to see the efficiency pay off or it improves, we will invest more. If we see the efficiency back off, we can invest less. So the question there is, how do you know what is the right level of non-growth and growth spend to make? To do this, we break down a lot of companies, and I'm going to tell you, I have 3 company examples here. They're not perfect, right? You have to make a few assumptions. You have to make an assumption on churn in order to get to your GEI, which is your growth efficiency index, because the growth efficiency index is really measured just on new bookings. And in order to get new bookings, right, you have to have the churn number there because it's the offset to it. You can kind of figure out what ARR growth is, but you have to have the churn offset to figure out what new bookings are. If some of these companies did not break out professional services versus subscription revenue, so we'd have to make an assumption there on how much of the revenue was services. But we think it's relatively accurate. The things to notice here, if you look at success factors, in their early years of 2006 and 2007, they invested heavily in growth, right? They're spending 160 up to 168% of their ARR in growth. They were burning a ton of capital. They are quickly able to achieve efficiencies in their non-growth areas, which is their COGS, G&A, and R&D as a percentage of ARR. But what is really interesting, what I think is interesting here, if you look at their 2009, when things started to look in the market, and we all remember what 2008, 2009, where things really got tight from a sales perspective, they actually decreased their spend and growth from 119% to 70%, and they remained relatively, they decreased it from 81% to 57% from a non-growth perspective. They really kind of pulled back and reset on how they're going to do things. For Cornerstone, and again, not perfect numbers because we had to make in a couple of assumptions, they've really had a very disciplined business if you think about it. They have been investing in their growth, and they essentially, in the very first year, invested 130%, but then said, you know what, our market can handle this. We're going to set ourselves up at 90% of ARR in growth because from an efficiency perspective, it actually looks like we're getting better. If you look at the bottom line, from 1.4 to 1.2 to 1.17, their growth efficiency is getting better. It is becoming more efficient for them to acquire ACV. And then on their non-growth dollars, they've effectively stayed between the 60 and 70 range really close to 60 every single year. Very, very disciplined investment, which allows them to plan for their business and really invest more dollars into growth, but also to be able to watch their growth numbers carefully. And on the third one is NetSuite, really, where we can see that in the early years, again, high investment in growth, but then really starting to taper back and bring that investment down into the 50th percentile, while bringing non-growth into the 40th, where they really never had a dramatic investment in their COGS, G&A, and R&D. But they were maintaining a relatively stable GEI for the last couple of years, but clearly driving towards operating profit because as a total, they're only spending 100% of ARR on their expenses. So once you decide how much to spend, and I encourage any company to go through these benchmarks, not these three, but you can use these three. We've actually broken down about 15 different companies. And then based on historical results and what companies have done, come up with what is good for you as an individual company. Then you need to track it, right? You need to track your ARR just meticulously, and that should be a number that every single member of your e-staff just knows by heart at any point in time. It should be driving every decision that they make, right? In your sales, you should have goals on ACV, but you should truly have goals on ARR, because if they close bad deals, those deals will churn, which results really in no new net ARR. In your growth or non-growth functions, they have to know ARR because that's a determinator on whether they're going to get more budget and be able to invest more. Your sales should also know their growth efficiency, right? This is actually the dollar you should hold them accountable to. If you as a company, you decide to invest a significant number in growth, you're doing it as a company. You can no longer go back and make arguments about, hey, we're throwing this much at you, sales. But you should say you need to make a very efficient use of those dollars. And then a recurring profit margin is really going to be the determiner of whether you're going to be a successful company going forward, meaning that you're going to have control over your business model. Because at any point in time, your market could soften or you may be less effective with your sales, but if you know you've had control over your recurring profit margin, you can always back off and produce cash if you need to. And finally, you need to put this all together for your executive team so that they can have a vision of the entire business, that they can see what the numbers do when you put them together from a subscription economy income statement perspective, so they understand the levers of all of these metrics and how each one of these levers can actually have a really big impact on their business. Hopefully this was helpful, you guys. I went a couple of minutes over because we do want to allow time for questions. Again, this is the way we run our business at Zuora. We built an entire product line based on the fact that subscription economy businesses are different than product economy business. And these differences are great because they allow for a much better business model. But if you don't understand them and you can't execute against them, you're going to fail as a business. And so we live this stuff internally, but we also love to help our customers and non-customers out as they make these shifts. So please reach out to me if you'd like to discuss further. Okay. And I'll hand it back to Rihanna.
Tyler, thank you. Lauren, thank you both. I thought that was very good. Please, again, if you have any questions, go ahead and ask them via the chat box on the left of the screen. I want to start just quickly, Lauren, with just a clarification. There was a question on the churn figures, and are they gross or net?
Yeah, it's a good question, and as the figures that I gave you, which were from last year's benchmarking, were for two different renewal rates, one for the number of customers that renew. And so that it depends on what you mean by net, because it is purely looking at the number of customers that you had signed up, say, from the prior period. So in that example, if you had 100 customers in 2012, so you're assuming that all 100 of them are up for renewal in 2013, and you only managed to renew 90 of them in 2013, that's a 90% renewal rate. That is not counting any new customers you might have added, because those would then be up for renewal in the next year. In terms of the dollars, that sometimes gets a little trickier, but it does include upselling within the same contract, but does not include new contracts. And just to talk a little bit about that point, as Tyler absolutely said, every company has to be very clear about their own metrics and how they're defining them. And I would totally agree. It makes sense to be as conservative as possible internally. If you notice, when public companies are talking about their renewal rates or churn rates, they typically don't say, they may say net, but that is a very squishy definition. You don't know if it's the number of customers, if it's the dollar value. It's a very vague number, and as we see in our data, it changes dramatically. We have one definition, and we work with each and every one of the hundreds of companies that participate in our benchmarking so that we're all working off of the same data, but that's not to say that you as a company internally might use a slightly different definition. But as Tyler said, you don't want to double count. So if you're counting it in one area, count it in another area.
Thank you. Now, Tyler, a little bit more on the ARR number. And you said you need to watch it meticulously. How often is that something you look at every single day? I mean, you said you can measure it quarterly, annually. How often just do you look at that number and measure it? And then do you have difficulty getting sales and other departments to really focus on the ARR number as opposed to the ACV?
I think so. We look at it every day, and we actually have weekly, what I would consider, broader executive meetings around what we call a Padre framework. So it's not novel. We didn't make it up, but Padre is pipeline, acquire, deploy, run, expand, and we add a PPM at the end, which is product, people, and money. But the first page of that whole Padre framework, so we put out a deck every week, has ARR as a fundamental, right? It's entering, what's new, what's churn, what's exiting, and really, week over week changes in that. Now, from a sales guy perspective, absolutely, the field is going to be motivated by what they're compensated by fundamentally, and they're going to have a corporate view for sure. But at the end of the day, their true motivation is going to be what they're compensated by. Our compensation is on ACV, so annual contract value. Now, we do things in the comp plans to motivate behavior, which will promote ARR and future growth of ARR. And the other thing that we do is we have a very tight link and control procedure by which sales and professional services work together, because professional services are really going to be the purveyors of truth when it comes to the fact that, hey, this company is a great fit for us. They're going to go live. They're going to be super successful, and we're going to be able to do it. And so they have a big voice when we're going through the sales cycle. I look at that as all being tangential to the end result of ARR.
Mm-hmm. Great, thank you. Lauren, I want to go back to the benchmarking for a minute. Were there any specific surprises you found in the data from last year's report, and did that lead to any new data points that you're particularly looking at this year?
Yeah, that's an interesting. There are a couple of really interesting things that came out last year we'll be looking at more this year. As I mentioned, one of the areas is around hosting and in-house and versus third-party hosting expenses and the percentage that companies are putting out in each area. We also, just generally found more companies that were not venture-backed but were, achieving profitability in the mid-teens or even $20 to $30 million. Typically in fairly specific vertical markets, but some of them, very profitable, and really taking advantage of the SaaS model in a very different dynamic than what you see with the venture-backed firms. We do have a few new metrics this year, and as I mentioned, in terms of renewal rates, we're moving to looking at renewal rates from a customer retention versus or the number of customers that affected again. But it is interesting to see how the numbers are changing. We also, what's interesting, we put data out between West Coast and East Coast companies. We see West Coast companies, one of the things that we benchmark is just how much the company spends in total on internal IT, so cell phones, computers, that kind of thing. And we definitely see that West Coast companies spend a little bit more on those kind of things than East Coast companies, and definitely than companies in the center of the country. So next time I bring out my BlackBerry, I'm not going to be too embarrassed about it anymore, because at least it's cheaper.
Great, thanks. And also, Lauren, do you think there will be new regulations requiring deeper disclosure and standards around definitions?
You mean from the SEC or from? I mean, for our own company, we've definitely been refining the definitions and are constantly working with CFOs and investors around what go into the benchmarks. I do know, if your question is directed to, the SEC is also looking at how to grapple with a lot of these non-GAAP numbers, and in fact, renewal rates is one thing that they've been contacting some CFOs of public SaaS companies and talking to them about if there's ways that could be formalized in a more standard definition, but it's a rat's nest in some ways.
Mm-hmm. Great, thank you. Well, we are approaching the top of the hour. I want to be appreciative of everybody's time. I want to thank Lauren and Tyler. I thought this was fantastic. Thank you to our attendees, and I want to remind you all that you will get a copy of the presentation and the slides as well. And I want to thank everybody again, and wish everybody a good rest of the week.
Thanks, Rihanna. Thanks for having us.
Thanks very much. Thanks for having us.
Thank you.